Okay, I think we're good to go. Good evening, everyone. Thanks for being here. Hope everyone's had a nice weekend. I'm assuming audio and video are okay. Clickety clacks, yeah, for sure. I'll try to be quiet with my water bottle usage. Okay, nice. Good to hear. So I think we can get rolling. First things first. Blockfolio sponsors Technical Roundup. Thank you to Blockfolio, mobile trading app. Really good way to actually get new people into crypto, if that's your thing. Very intuitive UI UX friendly app. That's what I've been doing with family members and siblings at least. No fees, swap from asset to asset, secure, all that good stuff. Powered by FTX, I'm sure you're all well aware. Blockfolio.com. Pay them a visit. And of course, like the video, subscribe to the channel, yada yada. You're all terribly familiar with the procedure, I'm sure. Now, plenty to get through as Bitcoin breaks the double-digit barrier in terms of up on the day. That's really good to see. We will discuss that. Broadly speaking, we're gonna cover some news stuff, go over Bitcoin, go over ETH, and then based on your feedback, if you want, I was willing or planning to do a little piece on funding. Like what it actually means when funding's positive, negative, why it matters, possible interpretations, like an accessible sort of summary, quick lesson on funding and futures premium, if that's a thing you guys care about. If not, that's fine as well, but it's sort of a relevant topic. And for those of you who listen to Technical Roundup, the podcast, I think without exception, every single one of our guests, at least on the trading side, looks at futures, premium or premiums, whatever. So, it's one of those things that you should at least have a baseline or base level understanding of. Anyway, where to listen to the podcast, sir? Spotify and YouTube under the same name. So let's jump into our little quick news bits and pieces. Did you just use the collect plural form of premium? Premier, yeah, of course. So first things first, JPMorgan is preparing to offer an actively managed Bitcoin fund. Now this story is particularly memey, and you can see all the news articles are leaning on this, because JPMorgan CEO Jamie Dimon has previously called Bitcoin a fraud. I remember that. Now the thing is, maybe I'm just too much of a boomer, or not kind of haha get owned mentality, but I don't really see this as sort of some sort of knockout blow. So Jamie Dimon, the CEO, can think whatever he thinks of Bitcoin, but then if JPMorgan's clients want Bitcoin or exposure to Bitcoin because it's going up a lot, then it's probably judicious and prudent of them as a business to offer their clients what they want. It doesn't necessarily mean that Jamie Dimon somehow owned or has conceded his position or whatever. I get the juxtaposition. It's attractive. Like, oh, you called it a fraud, now you're offering it to your clients. But I just kind of found this angle really boring. Like, he can think whatever he wants of Bitcoin. It's gone up a lot. His clients want to buy it. They're going to let their clients buy it or give them instruments to get exposure. Like, I don't really see the mass appeal in the, Jamie Dimon owned, he said this, now his bank's doing this. It's just kind of, I don't know, it's like a boring, low-hanging fruit angle for me, at least. I don't know if you agree or disagree. But yeah, it just seems like one of those things. If your clients want it, you're going to give it to them sort of deal. And of course, all the clients want it when it's up like 10 zillion%. So there's that. Made quite a bit of noise on Twitter. It's one of those very short-term cool things, but I don't think it matters like a whole lot. I at the very least wasn't like it's just a bit tiresome. Half of Twitter is like when prices are up, dunking on skeptics, which is totally cool, but it does get tiring after a while, you know. So I saw this more along those lines. Let's get rid of that. This one's really interesting. Turkish police detained 62 people in crypto exchange Thodex investigation. The bloke, the CEO, has run off, hasn't he? 390,000 active traders. I know the crypto community in Turkey is pretty active. But yeah, users unable to withdraw funds or access their accounts and say they may have been scammed. You've got the financial regulator, crimes investigation, etc., etc. It looks like he spoke to Bloomberg and he says, "The day I repay all my debt, I'll return to my country and give myself to justice." I don't know. It seems like a wild story. I think the story, like the real, the old wisdom is true that if it's not your keys, it's not your coins either. And when it comes to leverage, that very much applies as well. So like the conventional reason to use leverage, or the kind of textbook risk management reason to use leverage is to reduce counterparty risk, right? Which means you can trade those same position sizes as you normally would without having to keep as much money with your broker. Now, nowadays, when it comes to licensed and regulated exchanges, at least in the UK, it's very tightly regulated, especially when it comes to the segregation of funds, like client funds versus like the business's own money, so to speak. But yeah, just it's an interesting reminder that in the real world, quote unquote, if you were to ask the conservative use case for leverage, it's to reduce counterparty risk, right? You can trade the same size without keeping it with your broker. Whereas, of course, we all use leverage to make it all back in one trade, which is a totally valid use case as well. We've got a gentleman from he says, "I'm Turkish. This news is wrong. There's just 30k users and the volume is just 30 billion." I believe it. I saw that they stole 320 billion or some ridiculous number, which I didn't find particularly plausible. So it looks like the numbers are slightly high, but that sucks either way. Just a quick aside about custody, leverage, all of that type of stuff. So let's get rid of that. This was interesting only because we talked about central bank digital currencies a couple of weeks ago. So you can see 7 USDC wallet addresses were blacklisted on Wednesday. So this kind of stuff serves as a really good platform for making the distinction between permissionless and decentralized cryptocurrencies like Bitcoin, etc., versus sort of these white label compliant stablecoins in many cases. So if you talk to normies, they'll say, well, yeah, Bitcoin, Ethereum, whatever, but now I'm hearing that the ECB and the Bank of England, they all want their own cryptocurrency. And these kinds of cases showcase the main distinction between the two, especially when it comes to being permissionless, decentralized, etc. Now, yes, of course, there are practical barriers, as we've seen when big hacks happen. Exchanges do regularly blacklist wallet addresses as well when it comes to stolen funds. So you could argue that it's a distinction without a difference, but at the very least, it tends not to be particularly arbitrary. When it's you still have less power. You don't really censor the transactions when it comes to the permissionless blockchains, whereas in this case, you directly blacklist the addresses. So just your normal distinction between permissioned and permissionless currencies. I still think stablecoins are cool, even if the ECB, BOE, etc. want to come out with their central bank digital currencies. If it improves or increases transparency, great. But just bear in mind that it's not supposed to replace Bitcoin, Ethereum, or anything like that. I know it sounds obvious to us. We're supposedly smart money in crypto, but you'd be surprised how many normies think that CBDCs are like straight-on competitors when it comes to the stuff that we're used to. Someone's saying that Bitcoin's doing a bunch of stuff. I mean, it's not really done a whole lot, right? Let me look at this candle. Nothing massive yet. We will get to it, of course. We will get to it. The final bit, this creeps into the TA side. A good analysis from my friend BitDealer. So over the past week, looking at the crypto ecosystem, we know Bitcoin's been suffering and it's been down, but he works for the Tide. They do some really good stuff. Specifically, when it comes to sectors and rotations, it's been a really good week for the Solana ecosystem. You can see the coins he's chosen as representative of the Solana ecosystem: Ray, Cope, Sol itself, and then comparing it to, and Serum, of course, when comparing it to Bitcoin and Ethereum. Now, bear in mind, this was during a week or a period where Bitcoin really looked rough and was just breaking support and trading lower. So this is despite shaky market conditions in the majors. And this points to just a pretty cool trend more generally, that even with Bitcoin looking bearish, the correlations are really starting to, they're nowhere near as strong as before, where you just have this heat map and Bitcoin's red and everything else is red. Because everyone uses stable coins now, linear futures, etc., the flows, especially from a sector to sector point of view, tend to be a bit more isolated. And so you can still get pretty good moves in altcoins, especially over weekends, even if Bitcoin isn't looking too great. So that's pretty cool. Just gives you more stuff to trade, fewer correlations to worry about, a more interesting market generally. So that's pretty cool. And I hope that trend sticks around. That said, it doesn't really change the fact that Bitcoin, during the course of this move down, managed to mitigate or kind of ruin an ETH all-time high breakout. Like this candle at one point looked really good, but then Bitcoin just dragged it down, which is really impressive. But seems like most of that progress is being patched up. So that's kind of all I've got on the news stuff. I hope it was interesting. I know it was a bit brief. I will do the bit on funding and futures premium after we do the majors, if that's interesting. And if not, we can just go through charts and do other stuff as well. Bitcoin, up 10%. We have a green candle. Thank God. Feels like a lifetime since I've seen one of those, right? So the time frames that I'm primarily interested in are the weekly and the daily. So the weekly close, for me, was still kind of shitty. And I'll explain why. And I did that short clip on Twitter, which kind of summarized my views, right? If we take this as our range consolidation, or at least grab some levels from it, we have the top side here, the bottom side here, and then the midpoint roughly around 51, 52k, right? So on the closing basis, or even just looking at the past few weeks of price action, you had an attempt to break above the range high, didn't work, and then the most recent close was interacted with, but ultimately closed below the midpoint of the range. So within this consolidation structure, the only area that remains untested for the time being is the weekly range low in the mid to low 40s. So it's just like, I know the weekly time frame and the price levels look scary, etc., but the same rules apply. You have a range, as I tried to explain in that video. Price is in balance, right? It attempts to break from balance, isn't accepted, falls back within the consolidation. Normally it trades towards the mean of the range and then towards the other side of the range. And sometimes you get kind of mirror price action. Attempted breakout, no acceptance, back in. Attempted breakdown, no acceptance, back in. And then before, whatever trend forces or trends resume. So on the weekly time frame, there's some evidence of that developing. Tried to break, no dice. Weekly back in the range and closed below the midpoint. The only structure that remains untested for the time being is the weekly range low. Does it mean it has to go there? Absolutely not. We're going to examine some daily evidence, which would suggest that this is the low, and this just ends up being a kind of low, higher low scenario before trading higher. Absolutely plausible. But just in the back of my mind, I am aware that if the market starts shitting or trading back below sort of the weekly open, or especially the weekly midpoint, in the back of my mind, I've got this structure in mind that the only thing that hasn't been tested yet is the range low. So like, even if you think a target or a move isn't the most likely, it's still worth having some understanding of where those levels are, so that if the market really starts to move quickly, you're not panicking and scrambling for levels. You kind of have almost a plan B or some sort of background understanding of what's above you and what's below you. Does that make sense so far on the weekly time frame at least? Before we jump into the daily. Okay, nice. Now on the daily time frame, nice candle, right? About time. Feels like I forgot what one of these looked like. So if we add those range levels that we talked about from the weekly time frame, let's do that. Here we go. No. Yeah. Excuse me. Like, where are my settings? Hold on. Oh, here we go. Boop. Yeah. So this is our weekly range. We look on the daily time frame, and we do have a form of confluence at the range midpoint, which is this daily market structure level, big sort of deep swing low here. And we can just box out either this entire consolidation or that candle, which falls at around 52k or thereabouts. So the most bullish scenario imaginable is that this is it. This is the dip. Shit. Is that the dip we've had is the low, right? That's about as deep as it's going to go. And so if the market offers a pullback, instead of trading below the midpoint of the range and traveling towards the range low, the most bullish case is daily close above the mid-range and then finding support there before trading higher. And then you've got this kind of previous support-ish trouble area at 57, 58, which we know is the weekly range high, and anything too much above that, I mean, that's probably a run for the all-time high at that point, right? So again, from a weekly structure point of view, this is the range high. We've had a ton of interaction there. This is the range midpoint. In a similar vein, a ton of interaction there. And then you've got the range low where nothing's happened so far. If we get daily strength through 51k, that's your kind of new invalidation, in my opinion, if you're bullish. Which means that, yes, the weekly looks like shit, but if the weekly mid-range isn't going to act as resistance, then the case to be bearish becomes really difficult at that point, especially at least at these prices, right? Now, again, the weekly bias suggests that this is resistance, but we need some sort of alignment on the daily time frame. So, for example, if the market starts to pull back, but then you get really good price action and consecutive daily closes at this weekly quote-unquote resistance, then you're thinking, okay, there's no alignment between time frames. The weekly is telling me this should be resistance, but it's not acting as resistance. And if anything, the available evidence shows that it's acting as support, so I'm not going to sell it. Of course, the opposite is true as well. If this daily candle gets slammed and you close below 51, then you think, aha, so this is actually the weekly time frame wick, and now this area is acting as resistance. You know, it's only Monday, plenty of time for price action to unfold. Maybe now is the time to test the range low, so to speak. On a more kind of zoomed out basis, generally speaking for me, I'm not a huge fan of taking bets around the midpoint. As I said in that short clip, for me, I either want to buy strength where it matters, or I want to buy nukes and pray that it holds, right? So the whole buying nukes and pray that it holds is more or less, at least the first level, predicated at 45k, whether it's like that or a big nuke which then reclaims, whatever, some sort of aggressive price action that gets absorbed in the mid to low 40s. That's my preferred setup, like at support. Or alternatively, I'd rather buy strength, which for me would probably be daily/weekly close above 58k. At that point, I don't really see much of this as resistance. The top of the range and most of the key structure will have been reclaimed at that point, and that seems like a fairly straightforward long, with all of this more detached price action less likely to act as resistance, right? I'm not blind to the case that this is a market structure level. This could be the deviation, close above, moon it, etc. It's just not my preferred type of trading, although totally valid on its face. In terms of daily levels right now, so this is just a weekly imposed on the daily time frame. If we look at where the market is like right now in terms of shorter term levels as well, there is some daily resistance here at 54, 55. Nothing massive, but worth bearing in mind with a 10% candle anyway. It's just this area of prior lows, which got this quick retest before the dip and back to that same level now. You can see that reasonably clearly on the intraday timeframes as well, and I've got the weekly range so I don't lose track of it in blue. If the bottom's in, this is going to sound really obvious, but there was some really accommodating price action at the lows. You had a stab, a breakdown attempt, which I really thought was going to play out through this low. It didn't, got bid up, and then it's been a straight line since, with the good old range low remaining unperturbed, right? So if your argument is that that's it, the low is in, then this entire range, right? So this entire cluster of price action where this impulsive move came from, that should hold. So if you get any dips into this consolidation, generally speaking, the lower the better from a risk-reward perspective. If your argument is that the bottom is in, this is where your kind of risk-reward is optimized, because you don't want to be long below this consolidation, because at that point the probability of reaching for these higher time frame targets is super, super high, right? You can kind of see this area is a bit congested, which is why I'm relying more on either buying strength through the range high or buying nukes through the range low. This kind of congestion-y midpoint for me is slightly less attractive in terms of coming to high conviction decisions. Like, it looks good, don't get me wrong. This attempt to break the lows, immediately bought up, funding staying negative, etc., trading straight into structure, 10% up. Like, I'm not blind to that type of evidence. It's just, for me, there's no rush, right? And I have no problem waiting to trade the type of stuff that I like to trade, which is either buying overt strength where it matters or buying overt nukes and praying it works. Continuation setups closer, like in this congested area of resistance and close to the midpoint, especially given the weekly time frame isn't on my side. Like, if I want to be a buyer, I need to be fully cognizant that from the available evidence on the weekly time frame, I still, from what I have, this may come back to act as resistance, which means that any longs that I take a bit above it could, if the weekly close is taken seriously, end up being the wick, right? So that's also something to be aware of, which is why I'm happy to basically almost cross out this area. So yeah, whatever, I'll trade it on low time frames, but not put a lot of stock into it. The high time frame charts will start to become clear above the weekly range high or into the weekly range low, especially given the weekly closed below the midpoint. I'm going to be really careful if I'm a buyer in these areas, because I may end up being the wick in a unpleasant weekly candle in the worst case. Does that make any sense so far? Cred, why you said you don't like trading at midpoint? I mean, generally speaking, it's the mean, right? That's where the chop comes in. That's where reaching for the range low is generally about as likely as reaching for the range high. You're trading in the middle. I like trading at the extremes. I guess that's my answer there. Roberto says not appealing risk reward. Yeah, that's also true. Generally, it's easier to define your risk or optimize for risk reward at the extremes rather than at the midpoint, etc., etc. So yeah, that's that for the time being. Just bear in mind, in terms of chasing for bearish trades, from high to low, the market's already put in almost 30%. Like, in terms of bull market continuations, there isn't a ton of room left if historical precedent kind of means anything. So I'm not jumping. So even from yesterday's video, all the scenarios that I outlined were more or less looking to get long, right? Looking to jump into longs. So that's still my focus. I mean, yeah, there are certainly intraday opportunities at these levels or on these moves, but my kind of macro or higher time frame preference, whatever, I'm looking to press the green button until proven otherwise. It's just a question of where do I think is the best place or best area to do so, you know? So yeah, that's more or less Bitcoin. Let me know if none of that made sense. ETH continues to outperform. Looks good. Really doesn't have any of that structure weakness that Bitcoin had, neither on the weekly time frame nor on the daily time frame. Specifically, it held its retest, this pre-breakout range. I think we discussed it in the last live stream. Anything in here is support. Anything below it is fucked. It didn't even get scary, to be honest with you. It's just retesting the earliest or closest place to market as support, and has continued to go up. This relative strength is insane. Really, really good. I still stand by what I said last week, which I think was, if you're going to be bullish Bitcoin or bullish crypto, looking to buy dips, etc., Ethereum and Ethereum proxies, if you will, still one of the better candidates for doing so. In terms of where it is right now, arguably resistance at the former swing high. But if the market continues and Bitcoin breaks through its 55 level and keeps going higher, you're unlikely to find resistance at the previous all-time high, especially given it's already done its job once. So that's one to look out for. I'm contemplating almost like a brain-dead play, whereby there's this all-time highest close, and if there's a strong daily close above it, to just jump back into the market. Very overweight Ethereum to ride whatever trend continuation follows. And in that case, your invalidation is also very clear. You have the highest clear level, price closes above it in theory, right? That's a long, and then your invalidation is back below the level, so tends to be pretty close. So that's also something on my radar when it comes to ETH. I'm not blind. This relative strength has just been absolutely insane throughout this entire range. Bitcoin managed to ruin this all-time high breakout in the middle, which really sucks. But if it goes for it again, you get a clean daily close through it. That's probably a good trigger, or at least one I'll be cognizant of, as long as Bitcoin doesn't look like it's going to go to zero, right? It's that old, just like it said in the tweet, right? Long Ethereum when Bitcoin stops looking like shit, and I kind of stand by that, and think that's in a strong market, or at least in a market where Bitcoin isn't dragging everything lower or ruining these breakouts. It really does look like Ethereum is favored, so that's not something to lose sight of either. As for ETH-BTC, it's just up, right? Up. It's broken everything. Closed above everything. Higher high weekly, eat your heart out. Now, I'm generally satisfied with ETH-BTC, someone in the chat, as long as it doesn't fall below its breakout level. If we take this highest close, as long as it doesn't close below that, still generally pleased with ETH-BTC towards at least 0.05, but likely higher. And the reason I say likely higher is because the context is looks like a multi-year breakout from this range. Tried once, no dice, closed above finally, and then just looks like continuation from this macro breakout, which is pretty good, with the first level of resistance being here, 0.05, 0.06, and then the next one being the other side of that range at, well, closer to 0.08 to 0.09. Is that making sense so far? Okay, nice. Yeah, DeFi's been a bit of a mixed bag, but generally pretty good. Benefiting from, altcoins generally have been doing pretty well, unless you've chosen really, really poorly. These are the big ones. I haven't looked at a ton of these, to be completely honest with you. It kind of brings me back to the point we made in the beginning, where if in a weak market I'm seeing evidence that flows are favorable towards the Solana ecosystem. If the market shows strength, I think it just makes sense to follow the money, so to speak, and trade continuation for those pairs. Because if they're showing strength when the market's weak, they're going to presumably, or it's, stands to reason, or at least it's worth speculating on, that they'll continue to show strength or show even more strength if the market follows through and doesn't look like shit. It comes back to that relative strength concept we've spoken about, written about, whatever, that you want to keep an eye out when the market looks weak as to what's not looking weak, because then when the market's strong, it'll very likely outperform even further, or just do even better. And from the available evidence, it seems that the Solana ecosystem is where the money is. So if I'm going to position bullishly in altcoins, I think you have a case to build for continuation in this sector. You know what I mean? Does that make sense? Will you send the list with TR newsletter tomorrow? Is this? Yeah, of course. Any questions so far about Bitcoin, ETH, altcoin sectors? Let me know if there's follow-up to that. I'm not farming at the moment. It's a complete waste. Like, I'm being very capital inefficient. Like, I should be lending out my stable coins, farming, etc. I just haven't been at the moment. Because it's one of those things that I feel like I should read very carefully in terms of terms and conditions and how it actually operates before doing it. I know FTX makes it super, super easy. You just kind of click and it happens. But I feel like to be responsible, I should really read on how it works. But I just haven't made the time. I have not heard about Olympus. I don't know what that is. Thoughts on the privacy sector? It's just been less interesting, I think, than the others. Do you recommend day traders do study coin projects and do fundamental analysis? It depends. As a day trader, you probably don't need to. Like, it may not hurt. And I think you learn a lot of stuff by proxy anyway, but it's probably not a priority. You are totally missing out. I've heard that one before. And just as a quick kind of reminder, if we enter Ethereum season, like we get all-time high, breakout, ETH BTC keeps going, etc. When it comes to assessing which altcoin to ape into, you're going to want to look at the altcoin ETH pair at that point, right? Alt, ETH, when it comes to assessing whether the trade is worth it. Because if ETH starts ripping and you ape into higher risk altcoins, which in turn are less liquid and underperforming ETH, then that's generally speaking a bad trade, right? So I think if we see continuation of current trends, just ETH mooning, then if you're positioning or looking to allocate towards altcoins, I think you need to make the case for yourself that they need to outperform ETH more than anything else. In general, do you think crypto markets ignore fib retracements extensions? Not really. I mean, crypto is still pretty, especially new stuff, is still traded pretty technically, and stuff that's making all-time highs trades quite well. So I don't think it ignores fib retracements or extensions. Certainly didn't in 2017, you know? I don't really look at tokenomics, no. What do you think about ETH bouncing less than BTC? I mean, it kind of makes sense because it nuked, like structurally speaking, it nuked less than BTC as well. So some sort of catch up in Bitcoin, because ETH kind of held up the whole time and didn't lose any structure, whereas Bitcoin just got completely smashed and then reached some pretty extreme levels. So if on this bounce, it makes sense to see ETH bouncing less than Bitcoin, but it doesn't change ETH BTC looking outrageous for the time being, in my opinion at least. What do you think? Do you think ETH can show more efficient performance than Sol or DOT, etc. because of the fees? Yeah, I think the thing is, like, Binance Smart Chain and PancakeSwap, etc. They've been running into their own scaling issues, and I think there was a period of a couple of months where ETH just got completely battered by all of its competitors. Like Sol, like ETH was extremely expensive. Solana was mooning. Binance Smart Chain like properly kicked off, and CZ was like nuking ETH and disabling withdrawals. Polkadot had all of its scammy IDOs going mental, etc., etc. So the stars aligned negatively for ETH, and I think the price action reflected that. But I feel like the tides are shifting slightly back towards ETH. At least that's what the money is saying in terms of how it's been performing. Looking at ETH USD while the market's been bearish, looking at ETH BTC, it seems like the anti-ETH, or the competitor chain narrative kind of reached its pinnacle, at least in my opinion. And yeah, it's got some nice... I mean, look, I don't want to have the discussion as to whether EIP 1559 and all this other stuff, the MEV improvements are priced in or not. I honestly don't know, and I'm not well versed enough in the technicals to develop a strong view. But I can just look at a chart and say that ETH is very bid, so I wouldn't be ignoring that. Any rumors of big money / corporates getting into ETH? There have been a couple, right? I think there was a company in Singapore, or it was listed in the Hong Kong Stock Exchange, that was buying ETH. I think that there have been one or two. So perhaps we have the quarterly, I think either earnings or some more quarterly data coming out of US corpos. So maybe we'll see if anyone else is acquiring Bitcoin for their balance sheets. So that'll be interesting. 5 a.m. says Canadian ETF. Yes, for sure. And Buck, yeah, Chinese cosmetics brand bought a bunch of ETH. Made 2, that's the one. Made 2. Do you like, SK says, do you like for the Bitcoin pair for an alt to be at support, the USD pair to mirror that? I think it's just like anything else, SK. It's confluence, right? Like, you should generally pay attention to the pair that you're going to trade. But if you have confluence of, all the alt USD pairs look good because the market's bullish, but then, hey, this is also breaking out or at support against or in alt BTC, that's like an extra bit of confluence to suggest outperformance relative to that sector or other altcoins as well. So I don't think it needs to be there, but it's something you definitely like to see, Are all these news items like EIP irrelevant if your strategy relies upon price action anyway? I don't think it's irrelevant. Like, I think if you can get a grasp or have at least a background understanding of the fundamentals and upcoming catalysts, it can at least color your understanding of price action and give you some extra context to build an idea or build a thesis. So I think if you're trying to just trade news super short term, that's pretty difficult. But in terms of providing context to build a bigger, especially a higher time frame picture, it's still pretty useful to know, in my opinion. Okay. Right. Should we do a bit on futures, funding, premier, all of that type of stuff? Yes, no, maybe so. Are those real birds? No. I'm in my mother's basement, and because I was a very good son, she set up a wildlife / nature simulator in the nearby broom cupboard, and it's very compelling. No replacement for sunlight, but we're getting there. Okay. Yeah, let's do a bit on funding, futures premiums, premier, etc. Так. Ты где? Вот. Okay. Anyone who, if you want to buy Bybit has a nice page when it comes to different funding rates across exchanges and different crypto assets, etc. So check that out. Also, on the mandatory data list, I recommend Coinalyze. They are very good, and they've got like aggregated data at this point. So futures data, they've added this section called coins. So you can just go to Bitcoin, and it's got the open interest, and then specifically if you go to the indicators, you can get liquidations, open interest, predicted funding, etc. And it's aggregated, and it shows the calculation here as well. So a nice little overall picture without having to open everything or a bunch of different data feeds. Okay, so let's... How does Premier differ from funding? Can I make yield with Premier like good with funding? Yes. Tensor... I don't use tensor charts, no. Okay, so let's go back to first principles, right? Okay, so what is funding, right? So at its core, when we trade perps, we're trading perpetual futures. It's futures that don't have an expiration, right? They're in perpetuity. It's kind of etymology, English, whatever. So normally you have fixed date futures which expire at some point at different dates. So in crypto, you'll have to have March, September, etc., right? And those don't have funding, and they typically trade at a premium to the spot price, and that difference between the spot price and the price of the future, this is the basis, right? Now, the thing is, perpetual swaps, as the name suggests, they don't expire. Okay, so then the question is, we have what we want to trade, kind of the spot pair, and then we have the perp. The question is, how do we make sure that the perpetual swap, this never expiring future, trades somewhat close to or in line with the spot pair, right? Because again, at its core, or at least the way it's marketed to traders, a perpetual swap is basically easy spot trading with leverage. It doesn't expire, you don't need to roll positions, etc. So that's kind of the design at its core, again, how it's marketed to traders. So then how do you make sure that this never expiring future thing bears some sort of resemblance to the spot price, or as we'll come to know it, the index, right? And the mechanism, this is funding. Okay? So at its core, it's just a payment on your notional position size every funding period, which is usually every 8 hours, varies in some other exchanges. So think of it as kind of like financing or paying for your position. So just like futures typically trade at a premium, funding is typically positive as well. Now, just as an example, let's say this is the index, right? Which is spot. So normally what you'll get is, again, answering the question, what's the price? If we're trading, let's say, BTC perp, right? there's an index which is supposed to represent a spot price. It's like, okay, BTC Purple, what's the price of Bitcoin? Normally you have an index which is made up of some sort of weighted average of several spot exchange pairs. You got like Coinbase, Kraken, blah, 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 FTX, a bunch of them to come up with the index. So that's where that line is. And then let's say you have the perp itself trading above the index price. Okay? So this is kind of the basis here, right? So when the perp is trading above the index, ideally, or funding is designed to keep these two as close together as possible. So if this perp starts getting too far away from the spot price, there needs to be some sort of mechanism to drag it back or keep it in line. And that mechanism is funding. So if the perp is trading at a premium to the index, funding will be positive, which means that longs pay shorts, or you get paid if you're short. And of course, the opposite is true as well, although generally the exception to the rule. If for any reason the perp is trading at a discount to the index, funding will be negative, and shorts will be paying longs, or alternatively, you get paid if you're a long holder. Same thing, right? So again, the index price, what's the price of the thing that we're trying to emulate? So in this case, Bitcoin. The future price is the price of the perp itself, and then funding is some sort of derivative, as in the calculation, of how much the future is trading above or below the spot price. If it goes too far above, fuck off, mate, go back there. How do they create this pushback? It's by making longs expensive, right? Or more expensive. You have to pay to be long. Okay? And the opposite is true for the short side. Now, outside of... Hold on. Does that make sense so far? Okay, so far. Nice. Nice. And obviously there's like a proportion, it's proportionate. So if you have, for example, the perp is up here, and your index is just a little bit below it, right? More or less, the future is trading at the index price. Funding will be slightly positive, flat, no huge deal, right? Because that divergence, or the basis between the index and the price of the future, isn't really that big. They're more or less in line. Now, obviously, the more extreme that relationship becomes, so the bigger the basis becomes, or the gap, or the premium between the perp, as in the price of the future, and the index, the more skewed funding will become. Because as it gets more out of whack, say we get all the way here, right, the basis, or the premium in this case, becomes bigger, funding will also increase to really try to incentivize the market to push back, to push back towards the price of the index. So when people say funding is really high, that typically means that the perp, the future, is trading significantly above the spot price. There's a proportional relationship there. If it goes way out of whack, funding will go up as well to reflect that and try to bring it in, right? It's not just a flat. Funding is either negative or flat or positive. It moves in accordance with how big the premium or discount is, or basically the disconnect between the index price and the price of the future. Okay? Now, there are some delta neutral strategies that the existence of funding alone kind of brings into play. So, for example, if we go to Nice website, ftxpremiums.com. This table shows the annualized funding rate over a given interval for all perpetual futures available on FTX. Really cool website. Here you go. And it explains some of this stuff as well. So let's take an example of like the most basic delta neutral strategy. You have, well, I should really call it the index at this point, right? The index is here, and then the perp is trading significantly above it. Accordingly, funding will be positive, which means that longs will be paying shorts, right? So shorts get paid. And we know that the greater the premium, or the further the perp pushes away from the index, the higher funding will be, which means shorts will be getting paid more on an annualized basis. So an example of a delta neutral strategy, in this case, R being the funding, right, is, let's say funding is high and I want to collect it without exposing myself to directional risk. So the obvious trade is that you buy spot and then you sell the future / perp, right? Perp. There. So I buy and sell. So I buy spot and I sell an equivalent amount of the future. As a result, my deltas cancel out. I've got no directional risk, but because I'm short the future, I collect this positive funding every 8 hours or whatever normal period it is. Does that make sense so far? That's kind of the most basic delta neutral strategy, as simple as it gets when it comes to these things. And that's one of the reasons or sort of incentives behind, well, kind of why funding works, because it just becomes a very attractive arb when funding is really, really high. Like, you're leaving money on the table, a lot of supposedly easy money on the table. Again, I'm not going to talk about collateralization, etc., etc. If the funding is so high and you're not taking that arb trade, especially if you're like a big desk fund, whatever. Okay? Now, it's important to understand that just like most other tools, funding isn't just like a basic one, like, okay, funding's negative, which means moon it. Or funding is positive, which means doom it. It doesn't really work that way. Just like anything else, it's kind of contingent on context. So for example, positive funding isn't bearish, it's like the default, right? And when it comes to funding being high, that isn't always bearish either. And the most clear example we have of that is actually just Bitcoin, right? If I remember correctly, just pretty much during this leg up, especially early on, funding was really, really high on Bitcoin futures, even though we were in price discovery. And it got a lot of people nervous and calling for massive pullbacks, etc., even though we were in price discovery, just on the fact that funding was high alone. And that doesn't make any sense, right? Because if Bitcoin is mega mooning, or if a market is mega mooning, sometimes high funding is just the cost of being long the future, right? Or the perpetual swap, more specifically. It doesn't necessarily mean that the market's going to doom. It's just like, hey, yes, the market is very bullish. The participants generally agree, and therefore it's going to be expensive to get long because that side of the trade is very quote-unquote crowded, right? But it doesn't mean that it's just going to die just because the funding is high. In the same way, we had negative funding on this mega liquidation weekend dip here, right? Funding got negative and stayed negative for a while, but you can see price continued to trade lower. It's very much the same thing. Negative funding isn't necessarily bullish. It could just mean that you had an exaggerated liquidation cascade in the perpetual swap, right? The swap got battered, the perp got battered completely. It's trading at a discount to the index, but it doesn't mean someone's going to come in and buy it. And of course, the opposite is true as well, right? Like when the market's mega mooning and you have a premium on Coinbase because US institutions are just fucking FOMOing in both cases, you have a spot premium to futures, but you can see that there's quite a difference. Like it doesn't guarantee market outcome. So you can have negative funding and the market be really bullish, and then you can have negative funding and it just really meaning that a lot of people just got trashed, but it doesn't mean the bottom's in. So there's not kind of a very blatant linear relationship when it comes to the funding rate and what the market's going to do. It's just like context, right? So a really good example is at the extremes, and when you can build a kind of cohesive and internally consistent picture of price with funding as one of your tools. So a really good example that Alameda wrote about, specifically Trabuco, was the coin breakout, right? So when the IPO was coming out, you know, the Coinbase direct listing, the market was really bullish and leveraged on the breakout, and that obviously reflects the expectation of higher prices, right? When that doesn't happen, and those long positions start to move against participants, then funding is extra useful to give you context, right? The market's leveraged to the tits, it's expecting a mega moon, but the market's actually starting to roll over and lose a key level. Then you know that those leveraged holders are going to be a bit shaky, a bit in trouble, and that there's a lot of leverage to be unwound to the downside, right? In my notes, I've got market leverage to the tits, and then if bullish setups fail or breakout doesn't go anywhere, leverage will unwind. And you have to remember that when you're making those funding payments, they are charged to the notional amount of your position size, right? So let's say you're using a lot of leverage, like a 10x, and you manage to get long, whatever, 1 mil. Your funding payments will be on that 1 million, not the amount that you're using to leverage up to 1 million, right? So this shit gets pretty expensive. And you can imagine if you're cross-collateralized with every funding payment, your available balance is lower, you're less collateralized for that position, and your liquidation price starts to creep up on you, right? Because you've got less collateral. And you're paying funding every funding period on quite a big position. If that position goes nowhere, or even starts to move against you, especially when it all happens very quickly or at the same time, etc., that's when you get those big unwinds. Okay, and open interest plays a part there as well. Are there actually a lot of positions to liquidate in the first place? And how leveraged are they? How sensitive are they? Like, how much do they need the market to move, right? And of course, the opposite applies as well when it comes to context. So if funding is negative, it could mean that the derivatives ate shit on a big nuke, like we had here, but that's not necessarily indication of a market bottom. And or, of course, as we had in some, actually for quite long periods on the way up, it could just mean that someone is absolutely fucking slamming Coinbase and buying everything on there. And so the index, as a result, which is typically calculated from spot exchanges, is trading at a premium to the perp, or the future, which would also be a reason for funding being negative, right? So that's kind of what I mean when I say context is more important than anything. I don't really think it's hugely useful to say that, okay, high funding equals doom incoming, or negative funding equals moon incoming. We've had cases where the opposite played out, right? But where it is useful is building a more broad understanding or picture as to how people are positioned, how sensitive are they, and in what direction, right? Does that make sense so far? Is that at all useful? Okay. Sounds like we learned something. And yeah, I think Coinalyze has a lot of good and relevant indicators when it comes to these things. It's got aggregated open interest, and then you can also add aggregated funding rate and predicted funding rate as well, right? Yeah, you can start to use futures data to build a more coherent picture of the market, hopefully. Hopefully. Or not, that's fine as well. Just know what you're into. Or at the very least, you'll now know when you read that funding is high or funding is negative, etc. You'll at the very least know what it means. Any questions so far about any of that? I think open interest is a separate one. We'll have to do maybe next week or something. Can't do all the future stuff at the same time, can we? What percentage would you consider as high funding? Ooh, I mean that really depends. Is the really stupid answer. I've had some success looking at it not as in absolute terms, but in relative terms to where the market is in a range, or to similar kind of historical levels. And a lot of these indicators can visualize that or depict that quite nicely. But I don't really have like a cutoff point when it comes to this is high, this is low, whatever. Or maybe if you really want to get a sort of almost cynical answer, Twitter will tell you if funding is high. Did you get liquidated? I did not get liquidated, no. So summary version, right? There is an index. The index is made up of a basket, typically of spot exchanges. And so with that, you get the actual reference price in these cases when it comes to funding calculations. Now again, in some cases the funding calculations has like an interest rate element to it, but not always. In most cases it's a derivative of pretty much the difference between the price of the asset and the price of the future, and the difference there. So you have that. Then you have the actual thing that you're trading, which is the perp, right? If the perp is trading above the index price, funding will accordingly be positive. In doing so, it's more expensive to get long, or longs pay shorts, and that's supposed to incentivize the perp to push down and trade closer to the index price. Especially because as the difference between the index price and the perp grows, funding will also reflect that and grow as well. It's not like a binary thing, okay, funding's positive or funding's negative. There are obviously proportions and degrees to it. And so if the perp is trading significantly above the index price, the hope is that either longs will unwind or it's just too expensive, and or the arbitrage trade where you buy spot, sell the future, delta neutral, and collect the funding, that becomes too attractive, and participants take that ARB, and as a result, have the perp trade closer to the index. So in these cases, and usually is the case, the perp trades at a premium to the index, funding is positive. The further it trades away from the index, the more positively skewed funding will be, which means if you want to get long, it's bloody expensive. If you want to arb that, the yield is more attractive. Okay? And don't forget that the funding payments are charged on the notional amount that you're long. So if you're leveraged to the gills, even if the margin or the collateral you offered, you've leveraged it to the tits, you're still paying funding on the big position size you've established as a result. So generally speaking, the more aggressive participants are in the future or on the perp, the bigger the difference between these two, and funding will reflect that, and then hopefully get arbed so the two trade closer in line. Best way to use big, these big premia, or when funding is high, is either for the delta neutral arb trade, although I would generally say if you don't know what you're doing, don't do it when it comes to this, and it's mostly just really big desks taking that trade, although it's worth just experimenting to figure out how it works. In some cases, you really get some crazy numbers, even on Bitcoin perps, just relatively easy to navigate. So it's either that, or use it as context for the market, not to blind sell, but as context. So okay, the market's really bullish and the market's very leveraged because funding is high and the perp is significantly above the index. Now, does price look bearish? Is price moving in a way that accommodates these aggressive long holders? Where would they start getting nervous? At what prices or below which levels would they start puking and for some of that leverage to unwind? There's also time-based considerations. They bought a breakout and leveraged to the tits, right? But prices were moving sideways. And they've been paying back-to-back funding periods, and price hasn't moved anywhere. How many more of those can they take before they have to unwind as their liquidation price creeps higher, etc., etc.? So context, really important in those cases. Okay? Now, when you have, and so that's normally the perp will trade at a premium to the index. It's just a question of how much and what that information tells us. Now, sometimes the perp will trade at a discount to the index or below the index. As a result, all the opposite stuff applies. Shorts pay longs. You get paid to long. That's your negative funding. The same thing, the further the perp diverges from the index, the more skewed funding will become, just obviously in the opposite direction at that stage. In a similar vein, it doesn't guarantee directionality, right? And the reasons can be quite different, especially when you have a discounted or sort of negative funding. So the two examples that come to mind, one is spot bid chads, as we had on the run up, as in there's a spot exchange just completely just gobbling up all the Bitcoin available, as we had on Coinbase on the way up. So that's, you always have to watch the constituents of this index to see what's going on. Or, as is often the case, you have just a big liquidation crush. As a result of the cascading liquidations in the futures market, that exacerbated the move down, and it moved significantly below the price of the index, and you get negative funding. So you can see you almost get two extreme cases here, where you can get negative funding if the market's like mega bullish and Chad cash buyers are just mooning it, or, as we had recently, it could just be it's a liquidation crash or crush, as we had here, but that's no guarantee that someone's going to come in and buy the damn thing. And the takeaway lesson is that my personal view is that it's best used to get an overall, like building a broader picture of the market. How are futures traders positioned? What are their pain points? And is the market moving in a way that accommodates those leveraged positions? If not, and there's a case to be made that those long and or short holders are going to start unwinding, feeling pain, etc., that's when you get a lot of kind of confluent setups, opportunity, whatever. Does that make sense? Again, this is a very, very basic, cursory overview. I haven't talked about a ton of stuff. I barely scraped the surface on delta neutral strategies. Haven't mentioned like collateralization, how you can get wrecked on some of those strategies in fixed term futures if they get backwardated, etc. I haven't like mentioned any of that, but just to give you at least like a functional basic understanding of what funding is, what it means, what people say when it's high, it's low. If I've achieved that much, then I guess I've done my job somewhat. Let me know. I'd love to hear your feedback, either now while you're live in the chat or in the comments if you're listening to this in the future. That'd be cool. Okay. Cool. That's pretty much all I've got for the time being. I'm sure I've made some mistakes. It's not one of my super carefully prepared lessons, whatever. But I think the basic points have been communicated. Thank you to Blockfolio for sponsoring Technical Roundup. You don't have to worry about funding on Blockfolio. Spot trading, no leverage, easy life, happy wife. So go ahead and check them out at blockfolio.com. Let's get this video to 200 likes. I'm sure we could do that. That would be a nice little target to meet for the end of the stream. Otherwise, if you want to keep up to date with developments in a very important week, given the candle closes and the news and Ethereum poking at all-time highs, etc., go to trletter.com. Our newsletter will come out in about 24 hours. It'll have all the updates and conservative takes, etc., etc. The last signal, if you will, or kind of trigger that the newsletter gave was a long exit on this close here, and then something similarly defensive, neutral to bearish around here. So, and obviously trading this range pretty competently. I always joke that Technical Roundup trades a lot better than I do because it's pretty conservative. So if you're a fan of that, 1 email per week, it's free, blah, blah, blah. Go check it out. I'm sure we'll be wrong a lot, but sometimes we're right as well. And at the very least, wrong or right, our process and reasoning, etc., is there for you to dissect if that's your cup of tea. That's all I've got. Thanks for hanging out. Hope you've learned something. If not, my bad. And I'll see you next time. Take care.